All right, welcome everybody. Hey, it's Jeff Drake here, and we're going to take a look at the moving average as part of our indicator series here today. Now, the moving average is probably the most commonly used indicator in trading. In fact, people that don't use technical analysis and are using moving averages are actually using technical analysis. It is so commonly used because it helps in various ways as far as telling us what to do as far as prudent trade decisions. So let's begin by learning about the moving average. Well, the moving average is simply an average of prices over so many periods. And as an example, here I have a 10-period moving average, this blue line here, and it's averaging the close prices for Apple over the last 10 periods. So let's start from the right edge. You can see that we have this bar here around the 115.70 mark. I'd go back 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So it's starting here and it's averaging these prices. Now there are different types of moving averages. This is the simple moving average we'll be concentrating on in this tutorial, but we'll also talk about other types of moving averages in other installations of the indicator series. All right, so what is it actually used for? Well, there are basically two common uses for the moving average. Number one, it helps to smooth price. Here we are with Apple again. We're looking at a 20-period moving average now. And you can see we have this nice upward trend for Apple. It's not too difficult for us to smooth price at this point, but you can see the moving average just gives us almost a straight line upwards. All right, now it also helps us to determine trend direction. And if we look up to the top here in September of 2020, we can see that Apple fell through its 20-period moving average, meaning that is no longer trending upward and begins to trend downward at that point. Now, a simple way that a lot of people will use the moving average to trade with is to look for price to cross the moving average. We've already referred to that. Let's take a look at an example here. Looks like in late March of 2020, we had the price for Apple moving downward, pushes above the moving average, meaning that this downward trend is at least ending, and we can look for an upward trend. Of course, that's exactly what we got up until July. Now, take a look at what happened here in July as it pulled back and fell through the moving average. People would consider this a false signal. It was simply a pullback, not necessarily the end of the upward trend for Apple, as it did trend upward more after that. However, you can see that just by looking for price to cross the moving average, it can help you make prudent trade decisions. Now, if you're wondering if there are other ways to use a moving average, there's actually a lot of ways you can use a moving average. But one of the most common ways, or other ways that people will use a moving average, is to apply two moving averages. And that way you have a double reduction of price noise. Again, here we have that exact same chart for Apple. There's our blue line, which represents the 20-period moving average. We already talked about that. Now, I added a red line. You can see this is a 10-period moving average. All right, so it's a little faster than the 20-period. It's only looking back 10 periods. And you can use it the same way we referred to earlier. Instead of waiting for price to cross the moving average, you could look for the fast moving average to cross the slow moving average. So here we have the 10-period moving average move above the 20 just about the same time that price did, indicating that we may have a start of an upward trend. Now, here's the advantage of using two moving averages. Again, you have that double reduction of price noise. So instead of saying, oh, wow, here's the end of the trend, the 10-period moving average is, again, smoothing out that price data, and it'll not go below the 20-period moving average. So if you were trading this based off the cross of the two moving averages, you would stay in this trade and pick up a lot more of this move. So that is just one other way that you can use the moving average to help you with your trading. So let's talk about the pros and cons of using a moving average. Number one, it helps us reduce the price noise. We saw examples of that. You'll see that on chart after chart. And the moving average is, of course, just taking that average price so it smooths that out for us. It also helps us determine trend direction. We saw that as price crossed through the moving average, and also looking at a moving average moving through another moving average. Again, just helping us determine which direction the trend might actually be in. Now, the cons of moving averages is that they lag price. They're leading and lagging indicators, and a moving average is probably the most universally known lagging indicator because it does smooth that price, so it'll be a little bit slower than looking at actual price activity. Also, we looked at a very good trending market on that chart for Apple, but if you are in a market where the security is not trending that well, the moving average really isn't that useful. So be careful as far as false signals based off whether or not you're looking at a trending market with a moving average versus a trendless market with a moving average. All right, so that is our overview of the moving average. Now, in this example, we looked at a simple moving average. There are other types of moving averages, so look for further installments in our indicator series where we'll discuss different types of moving averages. Until then, this is Jeff Drake wishing you the best of luck in every trade you take.